Tax mistakes in retirement? It's the last thing you want. Getting ready for the longest break of your life and being faced with a tax bill because of rules you didn't even know about. Not getting this right could cost thousands, or worse, a mistake that could set your retirement years back. In this video, I'm going to go over 3 common retirement tax mistakes and how to avoid them. So my name's George and I'm a chartered financial planner. So let's go over number 1, triggering the money purchase annual allowance too early. So to explain what the money purchase annual allowance is, I firstly have to explain what the annual allowance is. And very simply, the annual allowance is the total amount you can accrue or contribute into a pension each tax year before there are any additional tax charges. Basically, the amount which is available to an individual for relief. It's not the only rule around what qualifies for individual pension tax relief, and I could potentially do a whole other video on the annual allowance. So for the purposes of this video, we will just take the very simple explanation that you get £40,000 annual allowance each year, meaning that you can put that into a pension and get tax relief. So now we know what the annual allowance is, next is a money purchase scheme. This is one without a guaranteed income where you build up a pot of money, and if any of this seems too advanced, please do watch my pension explainer video. Now, the money purchase annual allowance was introduced with pension freedoms. What it basically means that if you trigger this money purchase annual allowance, your allowance for a money purchase pension goes from potentially £40,000 per year to £4,000. And that's £4,000 including employer pension contributions. So as you can imagine, this is quite a hefty reduction. There are 8 potential events which can trigger this lower allowance for money purchase plans, and I'll put a link in the description on this. But the takeaway is, if you flexibly access benefits beyond taking just your tax-free cash, you can trigger this. So just to repeat, taking tax-free cash alone from a money purchase scheme is not a trigger for the money purchase annual allowance. And as the name also suggests, this only applies to money purchase pensions, so does not cover defined benefit arrangement accrual. However, as with all little tax quirks, it really is better to get advice specific to your circumstances than hear little bits of information without putting together how it all relates to you. So, as always, just get advice specific to you if you're in doubt. And let's just go over an example of why this situation could be so costly. And I'm going to talk you through Helen's situation. Okay, imagine Helen is 55 and she's a successful consultant earning about £90,000 per year. She's built up quite a sizable defined contribution pension. But she wants to take a year out from 55 and just have a bit of a break and travel. And this was one of the many benefits of a flexible pension. So she thinks, it makes sense. She accesses her pension benefits, but she does this via taking what's called an uncrystallised funds pension lump sum, where she takes 25% tax-free cash and 75% as income. Now, on the face of this actually makes sense from a tax perspective because she's got her personal allowance for the year. So it does seem like a good tax decision. The problem is though, based on her circumstances, she's now triggered the money purchase annual allowance. If she's retiring fully and didn't want to contribute going forward, that might not be a problem. But for a career break, that's going to severely hamper her ability to build up a pension in a tax efficient way going forward, assuming it's a money purchase scheme. She now only has £4,000 she can put into a money purchase pension per year. Alright, so why does this matter? Well, after enjoying a time off, Helen gets another role on similar money. The company actually has a really generous employer match, and being 56 now, she wants to start throwing as much money into her pension as she feasibly can. The problem? Her tax relief on contributions is limited to, that's right, £4,000 per year for a money purchase scheme. And if we just look at the simplest maths, assuming that all her pension contributions get higher rate tax relief, £4,000 per year at 40% tax relief is £1,600. £40,000 at 40% tax relief is £16,000. So that's potentially £14,400 per year tax relief that could be missed out on. So just to reiterate, it is only in relation to the money purchase schemes. So if she was lucky enough to have a defined benefit scheme with a new employer, that wouldn't have as much impact. But the reality is that there's not that many defined benefit schemes around anymore. So the chances are her ability to contribute is going to be restricted. Now, an alternative could have been, if she'd taken advice, perhaps understanding that she's probably going to work again going forward, she just takes some tax-free cash, which isn't a trigger for the money purchase annual allowance, or maybe draws on other income sources, maybe some ISAs, or whatever is appropriate. So it's something to watch out for, and this is where it comes to retirement planning, where the stakes are high. It's always worth getting advice. Okay, so let's go on to number 2. Cashing in your pension. So let's say in this example you have a pension and you want to just cash it all in straight away, for example, to buy a property. Side note, why not watch this video? The big tax problem here that can arise is that pension income is tax deferred. So if you withdraw it in one or sometimes even a couple of tax years, you can get seriously stung for tax because that tax deferred income is going to take a large amount of your marginal rates up. Basically, because you get taxed more on the more you earn in this country, a big pension withdrawal will likely have the effect that you're going to get very heavily taxed. Unless you intentionally spread out the withdrawals, you could get a lot of tax applied to you in 1 year. So let's go through an example. Let's say Ben is 60, has a £200,000 pension pot. He decides that he doesn't really like pensions and he thinks that property is a safer bet. He cashes in his pension in 1 year when he retires and he's got no other income. So even despite the fact he has no other income for that year, he still pays this amount of tax. He would actually lose his personal allowance, as I mentioned in another video, because he has more than £100,000 now in one tax year, and the total tax he pays is £52,460. But that's actually not all. Because he's buying a property, he also now has stamp duty to consider. What he's got left for the property, he'd have to pay another £4,800, which is just basically another tax for stamp duty before he even owned the property. And this means even before other buying costs, he's basically down £57,337 down to the taxman. Now look, if he was absolutely dead set on still doing this, he could have potentially spread it across 3 tax years if he'd planned in advance. The money wouldn't have been available immediately, but it also would mean that it wouldn't enter his higher rate tax bands. Anyway, that way we could get the tax down to about £22,000, which actually means a whopping £29,912 in tax saved by spreading it out. Now, I'm clearly not saying cashing in a pension even across 3 years is a good idea. Generally, it's madness. I'm just saying there is a least damaging way to do it. Okay, number 3 is not considering emergency tax. So this one's not as big as the other two, but still very much worthwhile bearing in mind. So unless a pension provider holds an up-to-date tax code, lump sum withdrawals from a pension plan will be subject to income tax under what's called emergency rate basis. Basically, what the provider do is that they assume that any withdrawal should be treated as if it were to be continued to paid each month, regardless of assessing it from a tax perspective as a one-off payment. The pension provider will therefore apply 1/12 of the personal allowance to the payment and will assess the rest of each remaining payment against 1/12 of your marginal rate. So what this means in very simple terms is you can get a much higher amount of tax applied for a one-off pension withdrawal than you expect. So let's see an example. Let's say you have no other income and you plan to take £60,000 from a pension. You get 25% tax-free, which is £15,000. But because you've also got some personal allowance, after tax, you should get about £53,514 if you have no other income. However, because of month 1 basis, you'll actually come out with a net of £41,474 due to emergency tax being applied. So that's quite a difference. And look, if you needed a specific amount quite urgently, quite a problem. Although it's nowhere near as irreversible as the first 2 mistakes, and even if more tax is deducted, HMRC can generally be quite prompt when paying refunds. But the thing to remember is that the provider must apply emergency tax rate to any lump sum unless you're able to provide a P45 from the current tax year following withdrawals from employment or your pension plan, or the pension provider already holds a P45 with an up-to-date cumulative tax code from HMRC as a result of perhaps previous withdrawals from a pension plan and they apply it. This means that the majority of individual withdrawals are likely to be subject to an emergency tax rate. This is actually more to do with how pay-as-you-earn, PAYE, operates and is not actually really a result of pension freedoms. So, can I ask you a question? Did you learn one thing you didn't know from this video? Well, look, if I've given you a little bit of value by teaching at least one thing of those 3, please do press the like button, and as a favour to me, consider subscribing because it helps getting this content out to more people like you. I'll be continuing these videos on retirement planning next week. This has been Principal's Personal Finance. I really appreciate you watching. See you next time.